quick recap. Essentially, when the 20 period moving average, when the prices are above the 20 period moving average and then 20 period moving average is slanted up, then it's like you're good to go for calls or long if you're buying stock. And then if it's the other way and the prices are below the 20 period moving average and the moving average is going downward, then you're okay to go short or buy puts. So that's the first part of it. And then entry is whenever the price is near the 20 period moving average and puts in a small candle. Typically it has to be the opposite color, red, than what you're going. Like if it's qualified for going long, that would be a green candle. That's what you want to, be in. You want to be in for green. So typically the qualifying candle is a red candle. This is a 1 minute chart I'm talking about. Is a red candle that's small, like small red candle. It doesn't have to be like, just small, not large, and maybe not perfectly medium. So you kind of have to look at all the sizes to know that. So in this one would be it, but it's green. So it'd be like advanced, like second level part of the strategy. But I can kind of tell because this is above the 200. This is above volume weighted average price. And it had a big, strong open. And it just dipped down and now it's likely to be going up and the slant is going up. So I mean, when you put that all together and you can say like, and look, it didn't really, if it closed 1 cent lower, it would have been red. So it's negligibly qualifying. It's definitely, it's negligibly not qualifying, meaning it's qualifying as the red candle because it's just about darn near a doji, which is the perfect X. So anyway, then the next candle, when the price breaks the top of that previous candle, then this is the strategy I talked about for an hour and a half on Thursday. You enter, and then look at that. You get this huge, huge run. And then there's rules for taking profits and for stopping out. I should tell you that because what if you try this tomorrow or something? So I'm going to tell you that because more important than finding that and getting in is making sure you get out without losing money and make a lot of money. So that when you do lose money, the times that it goes against you, you lose very, very little money. And when it goes in your direction, you make a lot of money. So what you do is you just put a stop below the trigger candle, that red candle. In this case, it was green. It's just that whatever that candle that was the trigger candle, not your entry candle, which is the next candle, but the trigger candle, which was the one you kind of like based the entry candle on. So that's what I mean by trigger candle. So you put a stop below there. So if the price goes down and breaks that low, you will get out instantly, like no questions asked, because this is only a profitable system if you adhere to the rule of getting out when at that point, because there's no other like rules like, oh, but maybe I can be flexible and let it run a little down, maybe it'll come back up. And no, it's not a profitable system like that. The rule is you have to get out at the bottom of that trigger candle if it goes against you. But the stop is going to be being raised and raised and raised and raised. So that's only in the first few candles that it'll be down there. So that's pretty cool. So that just protects you from loss. And then as you can see here, it runs and it runs and it runs. But where do you take profits? So let's say you bought with this kind of a strategy, you have to be careful trading options. You might want to try and trade something that's like $50 to $100. Apple's a good one. This is Apple. And then buy shares. But if you can't afford that and you have to do options, you can do options, but it's gonna have to be like a super, super liquid options chain. So Apple is one, and SPY is another one. They're very, and QQQ. Well, QQQ actually trades like a fifth of the volume of SPY, but Apple actually trades more than SPY. So Apple's more liquid and better for day trading options than even SPY by a smidgen. Anyway, my point here is if you're going to trade options, you do it at the money nearest expiration, at the money nearest expiration, or slightly out of the money in the direction of where things are hopefully going to go, like by just a little bit. Like you should be like almost right there. Okay, so but then the second part of that is make sure that when you get in, make sure you've got it all typed up and ready to go, because when you enter is like the exact moment of the breakout of that previous high of that other candle. So it's during this candle, it's during this next candle, and like right there, 114.3, and you just go, you know, like, and you probably should, if you're doing options, buy at the market, and that's why you want it to be very liquid, because you want like a penny of a spread so that you're getting a good price when you buy at market, and not having to battle the spread. But if you buy shares, you should be good. You know, you can get it. Maybe you'll be able to get in at limit, or just, you know, you're gonna have to do market. It's a small order, 100 shares, 250 shares max, and that's for people with like $25,000 account. So if you have like a $2,000 account, you'd buy like 3 shares or 5 shares or 10 shares or something. This strategy makes about between 1 to 3% on your portfolio per day, and gives between 3 and 7 trades per stock. Okay, so but moving on, so check this out. So now you're in, and the price is going up. You take your first profit, which should be between 1/10 of what you're holding, so 10%, or 1/3 of what you're holding, so 33%. So if you bought 3 contracts on options, you'd sell 1. If you bought 10 contracts on options, you might sell 1, 2, or 3. If you bought shares, you'd sell 10% to 33%. I've done a lot of the math on this, and 10% is more profitable at 33%. If you go in 33% steps, and 20% and any other percent is only like negligibly less profitable. Like, in other words, if you were going to make $250 on a trade at taking out 10% every time at the different profit targets, you might make $205 instead of $250. You'd make like $205 if you were taking out 20% or 30%. But the nice thing about taking out 20% or 30% instead of 10% is you're taking profits sooner. So you don't have to wait for, let's say, this trade to go bad, and then it stops you out at a profit. I'll show you how. And then you don't make very much money, but you make some. Gosh, I forget where my point was there, but like, you just take between 10 and 30% off. A third of your contracts to a 10th of your contracts. Okay, and that would be at what point? I'm going to tell you now. It's double the length of the trigger candle, not your entry candle, but the trigger candle. So the length of this trigger, and it doesn't have to be exact. You can just eyeball it. Like for me, what I do is I go like, oh, okay, see this grid? There's like a grid in the background. Oh, okay, it's about like 1.5 grids. 1.5 grids. But what you do is you take profit out at double the distance of that. So 1.5 grids in this case, which is, I mean, in cents, so we're talking the same language. It was 114.3 at the top and 114.14 at the bottom. So that's 16 cents. So 32 cents. Every 32 cents, you take off 10%. You know, you sell 10%, or if you had 10 contracts, every 32 cents of movement on the stock, you sell 1 contract at market, you know, because the contract's going to be going up in tandem with the stock, or 1/3 or 1/5, 20%. So the first point there would be 3 grid spaces, or 32 cents above that point in which you entered, which is like 1 penny above the trigger candle high. This strategy is like fully in detail on Thursday's class, so I'll get that posted somewhere. But so now you're in, and now we go up 32 cents, or for me, it's just three grids. See, 1 square, 1 square, 1 square. So right here, 114.6. And let's see, we were talking about it being 1.14.3. So I went up 30 cents. So it was pretty close, you know, just by eyeballing the little grid there. because you might not have enough time. Um, so anyway, right there on this candle, you take out 10% or 30%, somewhere in there. And then when it goes up to the next one, this is where things get interesting. You do it again, okay, so you take out another 10 to 30%, but you move your mental stop loss should the price go against you to break even. So that happens at profit target 2. And the reasoning for that is you want 2 target spaces to always be trailing your, the stop loss to be trailing by 2 target spaces. That gives it enough breathing room so that it can kind of like do some ebbing and flowing. So right there, when you take your next profit, you move your stop loss to break even. That's the next point up, break even. And then when it goes more, so 114.9 goes up 3 more grids. Here's another point where you take more profit. But now you're at profit point number 3. This would be the 3rd time we've taken profit. So now the stop moves up to profit target 1. You see, so you're always behind by 2. So it started at the low of the target candle. That was the stop loss. And then you had your entry at the high of the target candle. And then you had your first profit target, and you didn't move the stop. Then you have your second profit target, but now you move it to break even, where you entered. Then you have your third profit target, but now you move it up to your first profit target, your stop loss, where you get out. And these stop loss points are mental. Like, there's really you have to be a very active trader and using pretty great software to be able to type that in. Just kind of set it to set and forget, which probably most of you don't have. So that's okay, just as long as you are really alert, you've had some coffee, and when when the price hits exactly where your stop loss should be, you just get out right away. Sell all shares, sell our contracts at market, boom, And there'll be a little bit of slippage, but that's okay, because there's a little bit of slippage at every point, and altogether it's profitable. So in this case, let's keep watching this trade. It keeps going. We were at 115.3 was the last, let's see, 115.2 was the last profit target, and now our stop loss is all the way in the profit zone. I think it was here, yeah, 114.6. So should the price go back down to 114.6, you get all out, and that's still at a profit because that's above where you entered. So you're safe now, and so now 115.2, yep, and then 115.5 is the next point, and it does get there even on this